Is investing during a recession a smart move or a risky gamble? In today's video, we'll dive into how you can strategically navigate the stock market during tough economic times. From understanding market volatility to identifying the best sectors to invest in, we'll explore actionable strategies that can help you turn a downturn into an opportunity. Whether you're a seasoned investor or just getting started, stay tuned to learn how to make the most of a recessionary market. Recessions, while challenging, can offer unique investment opportunities for those with a disciplined approach. Economic downturns bring volatility and uncertainty, but they can also pave the way for long-term gains. Rather than abandoning the stock market, investors should reassess their strategies, focusing on fundamentals and maintaining a long-term perspective. By strategically planning and staying calm amidst market fluctuations, investors can build a resilient portfolio that not only weathers the storm, but potentially thrives. Recessions are a time to realign with risk and reward dynamics, turning uncertainty into a pathway for future growth. Understanding the risks and rewards. Investing in a recession carries both risks and rewards, with heightened market volatility often causing sharp price swings that can lead to sudden losses. However, this same volatility presents opportunities to buy quality stocks at discounted prices. Recessions trigger significant price fluctuations as investors react to economic uncertainty, corporate earnings reports, and changing interest rates, creating tempting entry points into fundamentally strong yet temporarily undervalued stocks. For example, during the 2008 financial crisis, patient investors who bought at depressed prices saw substantial gains when the market recovered. A long-term perspective is essential in such times, as markets have historically rebounded after downturns, from the Great Depression to the 2008 crisis. Short-term fluctuations often undervalue companies, offering buying opportunities for long-term growth. Strategic considerations. To effectively invest during a recession, a well-thought-out strategy is essential. Investors should focus on diversification, risk management, and a disciplined approach to buying and holding investments. Below are several key strategies to consider when navigating a recessionary environment. Number 1. Diversification. Diversification is one of the most effective ways to mitigate risk during a recession. By spreading your investments across various asset classes, stocks, bonds, real estate, etc., and sectors, you reduce the impact of any one investment's poor performance on your overall portfolio. Different assets and sectors react differently to economic downturns, and diversification can help smooth out the volatility. For instance, while some sectors, such as technology or consumer discretionary, may see steep declines during a recession, others, such as healthcare or utilities, may remain relatively stable or even thrive. By diversifying, you ensure that your portfolio has exposure to both defensive and growth-oriented assets, helping you weather the storm and participate in the recovery. Beyond diversifying across asset classes, it's important to diversify geographically as well. Recessions can affect different regions and economies in varying ways. International exposure through global stocks or funds can help further reduce your risk and increase the potential for gains when other markets recover more quickly than your domestic market. Number 2. Dollar cost averaging. Dollar cost averaging, DCA, is a powerful investment strategy during a recession. This approach involves investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. The main benefit of dollar cost averaging is that it helps to avoid the temptation of trying to time the market, which can be nearly impossible to do consistently. During a recession, stock prices are likely to be more volatile. By committing to invest a set amount on a regular basis, you buy more shares when prices are low and fewer shares when prices are high. Over time, this can lower the average cost of your investments and reduce the impact of short-term price fluctuations. For example, If you invest $1,000 every month into a particular stock or index fund, you will end up purchasing more shares during months when the market is down and fewer shares when the market is up. This strategy ensures that you continue to invest even during difficult times and positions you to benefit from the market's eventual recovery. Number 3. Focus on fundamentals. During a recession, focusing on the fundamentals of companies becomes crucial, as not all businesses will survive tough economic conditions. Companies with weak balance sheets, excessive debt, or unproven business models are more likely to struggle, while those with strong fundamentals tend to endure and emerge stronger. When evaluating investments, prioritize businesses with low debt, ample cash reserves, consistent cash flow, and resilient business models. Companies providing essential goods and services or maintaining profitability across economic cycles are better positioned to weather downturns. Investing in such recession-resistant companies increases your chances of benefiting from their survival and growth when the economy recovers. Number 4. Consider defensive sectors. Certain sectors, known as defensive sectors, are more resilient during recessions because they provide essential goods and services, regardless of the economic climate. These sectors tend to perform well and offer more stability compared to cyclical industries. For example, the healthcare sector remains strong during downturns, as people continue to need medical care and medications, making pharmaceutical and medical device companies more insulated from recessionary effects. Similarly, consumer staples, such as food, beverages, and household items, maintain steady demand since they are necessities that people purchase even in tough times. Utility companies, providing essential services like electricity, water, and gas, also experience stable demand, making them a defensive investment during downturns. Allocating part of your portfolio to these sectors can help reduce volatility and provide more consistent returns, offering a protective buffer during economic challenges. Number 5. Rebalance your portfolio. As market conditions change during a recession, your portfolio's asset allocation may shift away from your original target. For example, if stock prices fall significantly, the stock portion of your portfolio may decrease in value relative to your bond or cash holdings. To maintain your desired risk-return profile, it's important to regularly rebalance your portfolio by buying or selling assets as needed. Rebalancing ensures that you're not taking on more or less risk than you originally intended. It also forces you to adhere to a disciplined investment approach by selling overperforming assets and buying underperforming ones, helping you maintain a diversified portfolio and capitalize on opportunities created by market fluctuations. Tips for new investors. Starting to invest during a recession can feel intimidating, but it's also a great time to begin building a long-term portfolio. Begin with a small investment that won't jeopardize your financial stability, and as you gain confidence, gradually increase your exposure. Take time to educate yourself on different investment strategies, asset classes, and how the stock market operates. Knowledge is essential for making informed decisions. Additionally, seeking professional advice from a financial advisor can be beneficial, especially if you're unsure about your choices. They can help tailor a strategy based on your financial goals and risk tolerance, setting you up for success. Investing during a recession requires patience, discipline, and a long-term perspective. While it can be tempting to sell in the face of market volatility, history has shown that staying the course and adhering to a strategic approach can yield significant rewards. By diversifying your portfolio, focusing on fundamentals, and remaining committed to your long-term investment goals, you can position yourself to take advantage of the unique opportunities that recessions offer. Thanks for watching. If you found these investment tips helpful, don't forget to give this video a thumbs up and subscribe for more financial insights. Have questions or tips of your own? Drop them in the comments below. We'd love to hear from you. Remember, with the right approach, you can turn challenges into opportunities, even during a recession. Until next time, Stay informed and invest wisely.